Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after 11, and the equity markets have swung back. They were deeply red before. Now S&P futures are down 4, Nasdaq's up 2. S&P right now is 25.97.5. We traded down to 25.67.75, so about 30 points off the low. We're now joined by Vince Lanci and Tom McEntee. Each of these guys has over 30 years experience trading and trading options, and they are joining to discuss different option strategies. Let you guys take it from here.
Hey, good afternoon. Good morning, I should say. Thanks, Mike. We have a lot of new members, new subscribers, and just as an overview, Tom and I team up and we discuss many different levels of options, sometimes simultaneously, sometimes in different classes. Sometimes we'll have a beginner's type of class, which you can view on the replays or the videos for subscribers. Also, we'll talk about more complex things. Sometimes we lose people in the weeds that are beginners. Please don't be disheartened by that. We'll come back. It comes back because basically it's learning by osmosis. Sometimes because we repeat concepts a lot, and then sometimes it's very structured. Today we're going to do a combination of the two things. We've been through this before, but we think it should be done again in a more specific way. We're going to be looking for requests from subscribers on specific stocks that they may own or may already own. And we're going to, Tom's going to, using volatility, using how long you want to own a call, and using perhaps some charting as well, give you an idea of what type of calls can be used. So we're going to basically be revisiting at a basic level covered call rights, or what's also known as the buy right. And then in the second half, if we get to it, depending on how many stocks we have to run through here, or how many times I interrupt Tom, we're going to go through some concepts that I use in interviews when I owned Broad Capital Management, largest options market making firm, independently owned on the floor in New York at the time. Some interview questions that you'll find are very similar to Microsoft questions and Google questions, but they're very good for thinking like an options trader and a risk manager. So, Tom, you want to go ahead?
Yeah, sure. Hey, how's everybody doing? Good to be back with you, Vince. Michael, obviously, thank you for having us again. Yeah, I mean,
we don't know your real names, so please just type in a stock that you're interested in the news Q&A, and we're going to do a covered call strategy on it. If you don't have anything specifically, you'll leave Tom to his own devices, and he'll probably pick something.
My device, you know what? My devices. Anybody looking at Johnny John today? Johnson and Johnson. I mean, it's had a huge, rather tumultuous move lower here in these last couple of days. News related, obviously. I guess asbestos is a bad thing in baby powder. I wasn't quite sure. I know it was good for like shingle. It was good for insulation. I didn't know it was bad for baby powder.
Okay, so why don't we just run through first the definition of a covered call, and
yeah, sure.
Why people do it. I mean, remember the three things we did say. Anyone who's a beginner, there are subscribers that are new subscribers that are experienced, and new subscribers that are beginners. But everyone benefits from rehearing the basics. And the three ways options are used that Tom and I have discussed several times are: the first way is to create or generate wealth or income, and that will be either by buying an option because you think the market's going to move in that direction, or selling an option because you think it's going to be worthless, or selling an option to create income in a covered call right, which is what we're focusing on today. The second way the options are used are to hedge a position. I'm bullish on a stock, but I buy a put as insurance in case it goes down. The third way to use options is to trade volatility itself as the asset class. So you're not really interested in what direction the market goes in. You just want the market to go fast or slow. Today, we're focusing again on one, creating income with options, specifically subcategory writing calls on stocks that we own. So we're looking for a stock from someone. If not, we're going to do Johnson and Johnson. All right, J&J, it is. What's the story?
Okay. Johnny John, obviously it's been in the news here. I'd like, just as an aside here for all you technical guys. I see a gap down. I mean, I never traded down there. 126.68 from July 23. You got the top of gap this morning. So I keep an eye on that. Anyway, blah, blah, blah. Okay.
I think your current picture is a picture of the
oh, that's the wrong thing. I got you. I got no
problem. Keep my eye on that.
I want this on there. There you go. Okay. So this is a pic. This is a chart of Johnson & Johnson implied volatility.
I'm sorry. Last interruption, Tom. I'm sorry. Yeah. So what you're going to do is you're going to go through the technical chart, see the markets moved, and see if there's any opportunities that have shaken out because of that.
Yeah, I want to look at right. Absolutely. So here are two things. Okay. Now this here's the chart of John implied volatility, and you notice it's gone up from, I guess this is all 30-day stuff. So 30-day stuff was 15 on November 30th, currently around 30. Okay. Now here, the 52-week median for 30-day volatility is about 15 and a half. And like you see here, it's got 31. Okay, boom, boom, boom. Now I look at that. I think vol is inflated, exaggerated. It's definitely heightened. There's some heightened anxiety, and we see why, right? I mean, the stock had got up to, maybe it's a double top or a triple top up here at the 149 level. That's beyond my pay grade, and now it's coming dramatically to this 127 level. So the stock said it's had a news-related decline, which I guess by that definition it is binary, right? Leaving a yawning gap up here between 45 and a half.
But in a move like that, that's going to mean implied volatility is up. So
right.
So
when you get this, everybody.
Selling, right. If you are interested in buying Johnson & Johnson at these levels, it would also be a good level to consider selling a call because volatility is pumped right now, right?
Absolutely right. Absolutely right.
So this is the kind of thing you do for a living, basically.
Right. Now this is there are times you want to sell there are times you want to buy volatility and times you want to sell volatility. Now I would posit that right in here. I mean, this is as high as it's been for the last year in Johnson & Johnson. As you can see, this 30 level. I mean, it's never really touched it. I mean, vol's a mean reverter. It's going to revert back to the 15, 16 level. Perhaps not the next month or so. But once this news is absorbed by the market and the stock finds a range, wherever that might be, I would think that volatility will come in. But that notwithstanding, when approaching from that perspective, we're saying that you, whomever you might be, like the stock and you think it's got uncommon value. I mean, but typically the perverse nature of the game, a lot of people think it has uncommon value up to the 149 level. Not so much. It's more of an estimate at the 127 level. But as an option trader, as any type of trader, you want to take a counter. You want to look at things counterintuitively. So anyway, I think it might go lower, but I think now you are getting paid. We buy writing things. This is an income producer. Okay. You're selling it out of the money call or at the money call, however you want to fashion it against a long stock position. So what you're doing is generating income. Okay, if the stock goes a little bit higher and the calls are out of the money, you're going to pocket the premium and you also make money on the stock rally. Okay, so now what you're getting now is that I'll show you the screen. I'll show you my option screen at Johnny John. All right, here, let's go out 30 days. Let's go to regular way January expiration. You can go out 5% in the stock is about $7, right? $6.50, $7. Like the 140 call, you're getting $1.20, $1.15 for. All right, roughly 1%, right? Like 0.9%, something like that. Out six weeks. Now, I would say if I were to look back, and I'll tell you where Johnny John was a month ago. What you could have gotten for that particular call was, I'll tell you exactly what you would have gotten. It's going to it'll be freaking startling. It's hold on one second. Yeah, well, that thing's trading at 26 at 15 volatility. That thing was that you were getting about 73 cents for that. So now you're getting about 40. What's that? 60% over what you were normally getting. Okay, on a 9% out of the money freaking call option here in Johnny John. Now you're getting paid to sell options. You know, the perverse nature of the game is nobody wants to, you know, with implieds here, everyone loves to sell options because, you know, the market's just rallying, we're going higher, and I'll just sell these upside calls because, you know, I'll win both ways, and I'll sell these things for nothing, and, you know, I'll make my 50 cents out of, you know, I'll make my 60 cents out 40 days, whatever the heck that might be, around 32 days. Now all of a sudden you're getting almost twice the price. Does anybody want to sell it? Well, I don't really want to sell it here because this stock is just all over the place. But you can't take a look at you can't look at it from that perspective. If you take a cold, systematic methods, you know, process-driven approach to something, saying, well, in the long run, this volatility is going to come back to 16. I'm selling it at 29 right now. Now, depending on how far out you want to go, which is obviously important. I would look at here's the term structure. I mean, you're getting, well, you know, the put call skew is the put call skew is very, very high. It's trading around 5. We talked about this all through the summer and the early fall about variance, how variance swaps are determined. Variance swaps are determined by, you know, 25 delta put against a 25 delta call, usually out 30 days. That thing is currently trading at about 5%. The put's 5% over the call. In other words, the put's trading at 35 vol, and the call's trading at 30 vol. Typically, that's about typically about a little bit less than 2%, as you can see up here. Okay, so that's elevated. So the puts are elevated against the calls, obviously for obvious reasons. There's some fear, there's some chum in the freaking water. You know, everyone's gotten heightened levels of anxiety. So there's two ways to look at this thing. I'd want to say that, hey, this stock will probably bounce. I think it's going to bounce. I think this 127 level might work. But I mean, I can sell these. Let me make sure I put the right screen up here, because as we all know, when it comes to technology, I am not somewhat, I am inept. You can look at these 135s and 140s in January. Now you can buy the stock here, say 130 and a half. Okay. And I would say, let's do a 5% out of the money call. Okay. Which means I'd sell, essentially I'd create a hybrid. I'd say I buy 1,000 shares of stock, and then I would sell 5 each of these things. I would sell 5 of the Jan 35s, 5 of the 140s. Essentially, I'm creating a hybrid 137 and a half. See how I did that? 5 of each in the midpoint, right? 275, 137 and a half. And you could get, you could probably get about $2 for this thing. Do you see this? I mean, this is about 265. This is about $1.23. So what's that? 388. You get about $1.94 to sell that hybrid 137 and a half. Does everybody see that? If you don't, put it in the chat. If you don't put it in the chat, you can get $1.94 for that thing against your long stock. So essentially, what this is, and I want to bring this up because it's a caveat, but it's got to be mentioned. Essentially, when you're buy writing, you're selling a synthetic low. That is what you're doing. I mean, there's nothing. That's exactly what you do. You're selling a synthetic low. You're selling the 137 and a half synthetic low. That's what you have on. So if the stock would have rallied to 137 and a half, you're going to pocket the $1.94 premium, and you're going to make $7 on the stock here. So you're going to make money 2 ways if it does that. The stock, it's going to give you protection down to 120, 128.90.
What now? What do you mean by protection? What do you mean by protection?
It's not protection. I mean, it's going to.
No, it's okay. It's a euphemism. Explain it.
No, that was incorrect. It's not protection. It's not protective in nature. It's all it's going to do is defray your cost.
I didn't mean it negatively. I mean, people.
No. It's. I know you didn't. I just want to clarify. You're absolutely right. No, I know you didn't mean that.
I mean, that's fine. You don't really use a lot of protection, Tom.
No, people are under that mistaken.
Do you have any children?
2 that I know.
There you go. So you're not really a big user of protection. Anyway, moving forward.
That's good. So essentially what you're doing here is, okay, this is going to give me, my cost base is going to be lowered by say $2. So my cost base would be roughly 128.60. Okay. And that's what I'll have on. So, and to Vince's point, he's 100% right. And I would be remiss, or we would be remiss in not mentioning, this is not, when you're buy writing, it's not protective in this. This is a function of greed. Okay?
Right. And if I can add a little bit, if I can just interject, there are two ways to look at selling a call against a stock that you bought, and they're almost they may seem interchangeable, but when you do it, you should have an idea why you're doing it. Because if you start interchanging reasons, then you're just lying to yourself. The first reason is you intend to create a dividend stream over a long period of time, and you have picked a spot that you don't mind selling the stock at. So you've picked Johnson and Johnson, and you've bought Johnson and Johnson because the market has sold off. You were looking for an entry to buy. Here's two different traders doing the same thing for different reasons. Okay, you're looking to buy Johnson and Johnson on a dip. It sells off hard, and not only does it sell off hard, volatility is bid. And you say, I'm going to buy Johnson and Johnson at these levels, and I'm going to sell a call because volatility is bid, and I want to lower my cost basis, which means not entirely 100% means, but means more or less. You know the volatility is big. You're an advanced type of trader, and you're looking at this like a guy like Tom would say, and you're like, you know what? When volatility comes in, if the market starts to rally over time, slowly in an orderly fashion, I'll cover this call because I think Johnson and Johnson is going way above the call that I sold. I'm just selling this call because it happens to be the fattest in volatility terms, or at a level that I think is the peak for my income desires. So that person is doing it to Tom, in this case, would be doing it as an advanced trader to lower cost basis. Another person who would do it does it almost mechanically or methodically every month, and every month or every 6 months, or every 3 months, but on a regular basis, they sell a call, and they sell that call at a price that they would not mind. And there's different factors. You pick the option that you want to sell, the call that you want to sell based on a weighted valuation of priorities. One would be your price target for the stock. Another would be how much money you'd like to make in a dividend for the stock, assuming the stock will remain unchanged. And third is, did I mention price target for the stock?
Yes, you did.
Okay, good. So it's price target for the stock, how much money you'd like to make. You're not looking at the downside. You're looking at you're going to be owning this stock for 5 or 10 years. So you're going to be, to exaggerate, but that's pretty much the idea. So you're going to sell an option every month, struck at an area that you pick based on your criteria, which should be a level that you don't mind selling the stock, and a level that you like taking an income. And the reason you don't care about volatility, if you're trading that way, you may care, but it's very low on the list, is because you're doing this over and over. Law of large numbers. You're using ergodics. You're doing it every month of the year for 5 years, and you really don't care. 1 month volatility is going to be low. The next month it's going to be high. But the point is, on average, you'll be fine. But if you're an aggressive, advanced type trader, and you like Johnson and Johnson, and you're waiting for a dip, and in fact, you get that dip because of a news item, you want to go in and buy it. At the same time, volatility is going to be up across the board, meaning puts are bid for by people who want to buy insurance because they're worried about Johnson and Johnson. But simultaneously, that makes out of the money calls bid as well, because market makers like myself will bid the calls up because there's a relationship. And that's a great time for people like Tom, who has market maker background, but is more of a market taker and putting on long-term structured trades, to come in and say, I'm a buyer of Johnson and Johnson, and I want to lower my cost basis. And I think the market's going to go up in the next 60 days. So I'll sell a fat option, and I'll look to bring it back possibly as the market rallies. So there's two ways to look at your option that you sell. Either you're trying to create income, and that means you're going to do it every month or every 3 months or every regular basis, or you're trading counter the trend, which is you're buying a stock and you're selling the call at the same time. Whatever you do, stick with it. If you start changing reasons, like I bought this stock because I think it's going to go up $10, and then it goes down $2, and 3 months later you're like, I'm in it for the long run, you're lying to yourself. And I think that's important to know, regardless of what your reason is for selling a call against stock that you're long or stock that you just bought. Stick with your reason in doing it. Sorry about that, Tom.
That's quite all right. And speaking of targets and stuff like that, it's just interesting and random. I don't even know. I just picked out 5%, but 137.5 would essentially be the midpoint between this decline, like 149 down to 128. Down to 127 or so is 276 is 138. Kind of be the midpoint of this. From the top to today's low. If today's low is indeed valid. So that's that also is another reason why I would pick out that 137.5 line. You're getting paid to sell options now. Like I said, these would normally be about, in a normalized environment, they'd be about 72 cents.
Well, meaning you're getting paid in excess of the average volatility.
Right.
Volatility is pumped up right
normally
now.
Normally you're selling 16 volatility, and now you're selling
Yep.
28 vol. So it's a big premium.
Now, what Tom's describing here is actually something that Larry does sometimes. Well, first of all, he'll buy and sell options, but I'll give you an example. If active traders do what Tom is describing, the news comes out, Johnson & Johnson dumps. We're just making this up. The news comes out, earnings come out, disappoint. Johnson & Johnson dumps, and then it rallies later on and stabilizes. Larry typically does a lot of regression to the mean trading. I think Tom does it with volatility, and I'm more of a breakout or trend trader. But in a move like that, you could see a trader like Larry, and I've seen Larry Benedict do this on more than one occasion, where the market will drop, and he'll say, for whatever the reason, maybe the VIX isn't confirming it, maybe the Nasdaq starts to turn higher, and so he'll buy the S&P or the SPY. Or the ES, and simultaneously, because we're on the lows, he'll say, I don't think it's going to get much higher than, say, 20 handles from here. He'll sell a call against it. And what that does is it allows him to lower his cost basis because he's an active trader. And if for some reason we go home and he still has the position on, he doesn't have to put in a sell order to take his profits because that is his level. Anyway. I just wanted to relate that to the bunch of new subscribers we have, because a lot of Larry's trading is options based in concept, if not options based in practice. He looks at options as stop outs or ways to lessen his cost basis when he has an opinion on markets.
Yeah. Okay. So, So that's what I would use in Johnson and Johnson. I mean, here's a chance where I think I can fashion. I think I have a good entry point in the stock. If you were looking to buy it, here's your opportunity. I mean, Vince and I always talk about this, and I guess Larry and Mike as well. I mean, you hear the pundits on television say, "Well, I'd love to buy Johnson and Johnson." At 130, that's why I'd sell the 130 puts or some garbage like that. And all of a sudden, here it is, and now people are running away. So to me, that's always folly when people talk that way. So it's when your feet are to the fire.
Yeah, in fact, that's the opposite of what we're teaching now. But it's important to know that a lot of people have been. I know of 3 that have become day traders that are selling naked puts. Saying to themselves or rationalizing by saying, I would love to buy this stock $50 lower, so they sell the put. Well, the problem is the stock goes $70 lower, and there's a margin call involved. So to Tom's point, we will cover selling naked puts and how that can kill you, or selling naked calls and how that can kill you, and how to do it the right way if you really mean it, because that's what Warren Buffett did on the S&P in 2007. Of course, he had a little more information than we do.
That's probably true. So that's Johnson and Johnson. So essentially, a buy right is buy, call, buy, and write options, sell options, sell. I'm sorry, buy stock and write options. Buy stock, buy Johnson and Johnson stock. Sell this hybrid 137.5 call. Buy right. I guess that means the guy on the other side of it is selling wrong. Pun intended. That's what you're trying to do. So essentially what you are doing is selling a synthetic put, but you are selling it at an inflated volatility level. So if you believe in the Johnson & Johnson story, whatever that might be, you're definitely getting paid to sell option premium now. There's no doubt about it. Now, you could do that way. There's a lot of ways you can skin a cat, but now the corollary to the buy right and we might as well just throw this out there. We can move into this tomorrow. It's kind of seamless. Is that let's look at a stock that has recently been where volatility, I think, has come in quite dramatically. Let's look at our old friend Twilio, this is an old friend indeed, right? Okay. Here is Twilio. All right, here we go. This is Twilio vol. All right, everybody see that? Yeah. Okay, so it was trading around 44, from beginning of August through September, and spiked higher, but it was going out of business there for a while. And now here it is, sort of, approaching some of where the median's been. It's still high, but in relation to where the 52-week median's about 49, as you can see, as I'm highlighting over here, currently residing at 61. I mean, obviously it got as high as 89 a couple of weeks ago. I would start to look at this thing as not yet. Maybe it'll probably come in a little bit cheaper, but what I would look at is, hey, I mean, this stock has had a rather dramatic. Let me get the chart of this thing up here for you guys. I think what's going on here is, okay, I'll put that out there for you. Okay. This is a chart of, let me get rid of all these annotations. Okay. This is a chart of Twilio, not Twilio. I mean, I want to do Tesla. I'm so sorry. TSLA.
Tom? I think I got muted.
See that? This is a chart of Tesla volatility. Look at it. I mean, look here. Here it is. I mean, I guess the proverbial S hit the fan off August earnings somewhere in there, was plunging lower around. I remember July 31st. I guess August 1. Stock was, stock's probably 288, I think, give or take. And it was 41 vol. It's got as high as 84. Currently back in here at the 53 level. I mean, and it's been kind of flatlining here, for lack of a better word, for the better part of 6 or 7 weeks. So I would think that what's also going on here is this. I just think they should see this. Here is Twilio's rather I'm going to stop saying Twilio. This is Tesla's rather dramatic rise from the ashes, like a phoenix, to quote George Costanza's father, like a phoenix rising from the ashes. Here's Tesla what you have here. If you look at remember where the volatility was, how heightened it was. Here, let's look at this period here from August, from October, from this August level. This is September 6th to October. Now I'll show you that. Now remember those levels. There's about 250 in the stock. Now here is where Tesla volatility was during those freaking periods of time. This stock was trading. This vol was trading somewhere north.
Can you hear me, Tom?
Yeah, I can hear volatility at its apex in here, and probably back. You can hear me. Okay, now we have this enormous rally. So what I think you've had here is so many people who have so much money has been burned in put options in this thing. And I think what you've got here is now there's put buyer fatigue. They don't want to buy them anymore. You've had an enormous rally in this stock. To me, this was the kick in the freaking stomach when you're laying on the freaking sidewalk after it's all over, right? I mean, you've got this enormous rally in the stock, challenging new highs. Might be a triple top up in here, but that's once again out of my pay grade. You had an enormous rally from 244, I believe it was, up to 379. That's roughly about 55%, an enormous rally. So now, but the stock the ranges have narrowed, the number of gaps that you would get in this thing have diminished somewhat. Stock has kind of settled into more of a manageable range. Even a day like today, it's got less than a 3% range. Which would kind of anomalous when you're having when the market will be as volatile as it's been. So this
Tom,
yes,
Tom, I'm sorry. We only have 2 minutes left. Could you throw Apple up?
yeah.
There
So
right now?
let's look at Tesla. Yeah, when I would look at Tesla is this. I think this 389 level or something like that. You want to look to sell it if you get a shot up in here. I would look to do the exact opposite of what we did in here it is. Here's my Tesla screen. Let's go out to January. Same deal. Apples to apples. Jan, 5% out of the money. Roughly, what's that? About 18 points. Puts us at the 380 line. It's 51 vol in here. The opposite of the buy right is the synthetic put. That's where I would buy calls. So you got to pay $15.30 for these 380 calls and sell the stock at 362. Essentially, I am paying about 33 bucks. 15 plus 380 is 395 minus the stock price. 362 is 33. So I'm paying $33 for the synthetic 380 put. That's what that is. I would look to do that in Tesla on a rally, which I think you might get in here really just really test everyone's freaking patience. I mean, it's put buyers have been burned so many times. Volatility's come in dramatically. The stock has rallied dramatically. The stock's settling into a range. Vol's at or near its nadir. Now I would want to do the exact opposite of what you could do in Johnny John. I would look to buy upside calls, 5% out of the money calls, sell the stock. Now, obviously,
good afternoon, everybody. Welcome back to the Opportunistic Trader. We're now joined by...
Are we still good?
Yeah, we are. That was just me hitting a button by accident.
Oh, okay. So I would do the exact opposite in Tesla. I'd look to buy these calls and sell stock, okay? That would be the opposite. That would be a synthetic put. Buy right, synthetic put. That's how these things were framed on the floor. What's the buy right synthetic put market? Where do I buy stock and sell call? Where do I buy call and sell stock? Okay. So if we made $15 the midpoint here, fair value, that would make the synthetic puts take 15 plus 380 is 395 minus, we'll say 362. We'll call it that way. Would be $33. So some of them might make your market, hey, 32 and a half bid at 33 and a half. Okay, so I'll pay 32 and a half for the synthetic put. I'll sell it at 33 and a half. So that's how they make a market. So I would look to do something like this, just trying to be you want to be going to contra trend and being a contrarian. You're going to buy depressed volatility on a relative basis, depressed volatility in Tesla. Compared to where it's been with a stock at or near its apex, roughly about 15 points off its high. Buying depressed vol, selling a stock at or near its apex, and that would be the exact opposite of what you're doing in Johnny John. Johnny John here, you got a stock, a good what is it, about 7% off? I'm sorry, it's about 15% off its highs, roughly. Yeah, 22, about 15% off its highs. When it got down to 127 ish, and volatility normally about 16, currently trading what we like at 28, 29. So you're getting a big premium there. You're getting a 75% premium to where it normally trades. So you're getting heightened volatility here, low stock price, elevated vol, low stock price. I want to buy low stock price, relative basis, obviously, certainly in terms of recent history. Low stock price, high vol. Exact in Tesla, it's high stock price, low vol. That's the way I look at things. Like I said, the Tesla might wait for a rally. Give it some time, but I think you want to do something like that. And the exact opposite in Johnny John. That's how a professional, and I use that term loosely, would look to do these things. So buy rights, buy stock, sell options. Buy stock, sell options. The synthetic put, which is the opposite, buy options, sell stock. So it's the exact opposite thing. It's two things you have in your freaking toolbox to keep track of. You want to do buy rights when you're getting paid. I don't want to be selling options at 12 volatility when the VIX is at 12, because that's just a recipe for disaster. Now you're getting paid. Now is the time to employ these strategies. Find a stock you like. You got a target. Where do I want to buy it? I'm getting paid to sell options. That's where you should be doing these things. Okay, and I'll leave it at that.
There you go. Mike needs the system. I think we have an interview coming up at noon. I'm not really sure who it is, but I'm sure it's awesome, but not as awesome as us. But I want to go out just leaving everyone with an interview question for fun. Long time ago, there was a show called Let's Make a Deal. It may actually be back on the air with some other nut job. But in Let's Make a Deal, there were 3 doors. This is a question that Google and Microsoft ask as well. But it all started with options trading firms like Cooper Neff and Susquehanna. It's a fact that behind one of the 3 doors is $1 million. It's also a fact that behind one of the 3 doors is nothing. And it's a fact that behind one of the 3 doors is a goat, we'll just say, a booby prize. And Monty Hall, who was the MC, would ask you to pick a door. And upon picking a door, we'll just lay out some facts so you can work with it from there. You had a 33% chance of picking the right door. Monty Hall knows the right door, but you do not. So you pick door number 1. Then Monty Hall removes door number 3. And the question asked of you as an interviewee or as a person who's understanding and learning conditional probabilities, which are important in options understanding, is this. Now that Monty Hall has removed door number 3 and you have picked door number 1, he asks you then, in real life, he would ask you, would you care to switch to door number 2? And the answer I gave in the interview was no, because it was a 33% chance before and it's a 33% chance after. That is the wrong answer. The answer is you always switch, and we will leave that up to you to figure out why and to demonstrate why if you wish to in our next class. Hope that's enough for today. I threw a couple links out there. One of them is on a PowerPoint presentation that Tom and I put together for options, very organized and easy to follow along. Another is a class on why butterflies are very important. You would, if you're not familiar with volatility, you would serve yourself well to look at least one of those. If you are familiar, it would be fun to listen to them, I think, because of the advanced concepts that Tom peppers our conversation with. But thank you for joining us. And I guess that's it, right?
Yeah. Hey, Vince, great being with you. We're going to do it again tomorrow at 11 a.m. So same bad time, same bad channel.
We should talk movies next time. We should talk